Welcome to GNCC Espresso Live. My name is Mishka Balsom and I will be your moderator for the next hour. The purpose of this series is to better understand how COVID-19 has impacted our lives so far and to start thinking about tomorrow. How will this pandemic have changed how we live, how we work, how our societies will function? How has it impacted our corporate partnerships, supply chains, and business operations? And how will it reshape our collective priorities? It is critical for us to convene for conversations that encourage us to stretch our minds while determining on how to best move forward. The decisions that we are going to make in the weeks and months to come will be the foundation of our economic recovery. In times like these, businesses long for data, for insight, to define the vast spectrum of what recovery looks like, when it will take place, the short and long-term impact on organizations, household income, sectors, and so much more. To provide us with their expert view, we are joined by two members with TD Securities, Robert Both, macro strategist based out of Toronto, and Mazen Issa, senior strategist for the global strategy team based out of New York City. Thank you very much for joining us this morning. But before we get into our conversation with Mazen and Robert, we are being joined by Scott Galbraith, District VP for TD Commercial Banking, providing us with a brief update. Scott, over to you.
Thank you very much, Mishka, and good morning, everyone. My name is Scott Galbraith. I'm the District Vice President for TD Commercial Banking here in Niagara. We're thrilled to be able to contribute in this way as part of the new virtual economy. COVID-19 has created extraordinary times for us here in Canada and at TD and for many around the world. We're proud of our colleagues' commitment to the bank and, more importantly, our customers. We're working very hard to reduce the spread of the virus at TD, as our first priority is ensuring the health and safety of all the folks that are working. I'm happy to report that we're actually starting to reopen a couple of locations in some areas across the country based on low new transmission numbers. I think that's a great sign as we look to return to whatever level of normalcy is advised by public health. But as confidence grows that the virus is becoming more and more contained, it should be easier for folks to return to normal day-to-day lives and have the same types of interactions with the bank that you've had in the past. In the business bank, our primary focus has been taking care of clients. The entrepreneurs and small businesses we deal with are the backbone of the economy. So we take very seriously our responsibility in supporting all of you and all of them in this time of need. A couple of different ways that taking care of has taken form. Our goal has been to make contact from a one-on-one perspective with as many business owners and as many entrepreneurs as we can. The last time I checked, we've done about 900 of those calls in the last 6 weeks. So that's been exciting, but also a big undertaking. We've done, in my unit, 160 principal deferrals. All of the Canadian banks are acting in similar respects on personal mortgages, deferring principal payments. It's been a little different on the business banking side. All of the banks are taking their own approach, but I'm happy to report here at TD, we're doing that very actively as a means of helping folks cope with cash flow shortfalls and needs as they get through the current time. We're also providing bulges, temporary increases in lines of credit where that makes sense. Perhaps most importantly, loosely quoting our CEO, Bharat Masrani, he was quoted about a month ago as saying the bank's most important function through the COVID crisis is to support the implementation of the various government programs that are being rolled out. So the most critical one, Canadian Emergency Business Account, which is a maximum $40,000 loan, interest-free, $10,000 of that forgivable after a couple of years, subject to certain conditions. So all of the Canadian banks, credit unions, and financial institutions have participated in various respects in this. And it's been a great example of the Canadian spirit pulling together and getting something done, working with the government to allow for the rollout of that in a relatively pain-free fashion. It was conjured out of thin air in 3 weeks, so there's always going to be growing pains. But last I checked, we were at about 150,000 approved loans in that respect. So very proud of the way that we've interacted with the federal government administration of this program. We're also currently in the process of launching other programs for larger businesses, working in conjunction with the Business Development Bank of Canada and Export Development Canada. So you'll see those programs. They're launching as we speak. So certainly would encourage folks to reach out to your banker if you have any questions about any of those things. So yeah, that said, over the course of the next several weeks and months, we want to keep talking to clients and business owners throughout Niagara about what a COVID and a post-COVID world looks like. Are beginning to understand that this isn't the 2-week or even 2-month phenomenon that perhaps many of us thought it would be when the kids were given the extended March break. That seems like 2 years ago. So I think it's important that we understand how it's going to look for us in the short, medium, and the long run. My final point would be, I think we're happy to dialogue with anyone in the community about any of these topical subjects, whether that means looking at wills, looking at your succession planning situations. We've seen a massive rise in the use of electronic funds transfer, wire payments, remote deposit capture for checks. And then finally, the last one that we've seen a massive ramp up in is fraud. So I think I just offer that up to anyone in the Niagara Chamber community. Things are changing very quickly, so certainly feel free to reach out to anyone at TD or any bank for that matter. So thank you again to the Chamber of Commerce for the opportunity to participate in today's session. We hope you enjoy the presentation and look forward to the chance to talk again soon. Thanks again, everyone.
Thank you very much, Scott. We really appreciate it too. Hearing from you and hearing what is actually happening at the local level. So thank you very much. So let's get started. To all the participants, we really want to encourage a great dialogue. If you have any questions, there are 2 options. There on the right-hand side of your screen, you will see the symbol of a hand. By clicking that, we will know that you want to ask a question and we will unmute you. So please watch for that. And the second option is the chat box. It's a field where you can type in the question. We can see it here on our end, and we will do our best to get to your question that you have. And lastly, I wanted to also thank everyone who has actually forwarded their questions already to us via social media or email, and we'll do our best to answer all of them. So let's get started. One of the first questions that has come in from a number of people, and I think it's maybe it's a bit of a heavy one to start out with, but why not, as we're getting into the dialogue. And the question is, what do you see happening in the Canadian economy, and how bad is the economic situation? Who's going to be hurt most and the least in the months to come? And maybe if I can direct this question to Mazen first, and then maybe have Robert take over from there. Mazen, it's a bit of a heavy question, but what is your take when you take a look at the Canadian economy, of what is happening? How good, how bad is it? What does recovery look like?
Thank you for the question. So it is definitely a heavy question to try to answer. I think one of the ways that I'm sure Rob will also opine on as well is just looking at some of the structural issues that have been built up in the Canadian economy that are now being tested all at the same time. So it is a fairly bleak outlook that we have on the Canadian economy, and some of that is arising to challenges related to, on the one hand, a turn to trade shock. For example, the collapse in oil prices is particularly problematic for the western provinces of Canada. That is an important source of income for those that live there. And we saw this back in 2014, 2015, when oil prices collapsed. There was some pain that was felt in that region. So that's definitely one area of the economy that I think will be particularly problematic. That will have, I suspect, ripple effects into other pockets of the economy. Unfortunately, it would lead to a rise in bankruptcies. And one of the challenges, I think, kind of coming into this shock is that Canada was already at a bit of a troublesome start in terms of bankruptcies already rising in some pockets of the economy. So that will have ripple effects. The other aspect I think will be particularly challenging is on the household wealth side, household indebtedness related to the housing market, of course. And I think the big challenge there is that back in 2008, when the financial crisis struck, the Canadian economy was able to weather the storm better than other economies, in large part because the consumer largely bailed out the economy as a whole. In that process, with low interest rates, you've seen a significant accumulation of debt over the last several years to be one among the highest in the developed economies. And so now the challenge is that with people losing their jobs, and certainly demand for, I think going forward will be a challenge as well, that you see that imbalance within household indebtedness become tested significantly. And that could imply that Canada has a longer recovery process than some of the other economies, like the US, for instance. When the financial crisis struck, it was very much the housing market was the epicenter of that. And the difference that we've seen in terms of trends is that while Canadian households accumulated debt since the financial crisis, at the same time, the US deleveraged. So household balance sheets may be in better position for US households compared to the Canadian households. And I think that just creates a much more difficult environment to manage the recovery going forward. If Rob has anything else that he would like to add to that.
Yeah, Robert, what is your take on it?
Thank you, Mishka. It is a very it's a very good question, and right now it's difficult to overstate the severity of the current slowdown that we're in. If you go back to previous slowdowns that have hit the Canadian economy, 2008 and 2014, it was really the recovery in the oil and gas sector that helped lift us out of the global financial crisis. And in 2014, 2015, it was the Canadian consumer and the housing market that helped us recover faster. This time around, it looks like neither of those sectors are going to be as reliable to help us get out of this slowdown. So the Canadian economy is facing some significant challenges. Right now, we're forecasting 2020 gross domestic product, which is the aggregate output of the economy, to fall by nearly 8% this year. That's a much more significant contraction than we saw in 2008. And if you want to discuss who would be the most and least affected by that slowdown, we have to look at those commodity producing provinces, which will see the largest impact. So Alberta is one, and Newfoundland as well. These regions are dealing not only with the combined impact of emergency stay-at-home measures, but also a sharp drop in commodity prices as a result of a pullback in global demand. The least impacted provinces should be those that are less exposed to the commodities and other cyclical industries, and also those that have seen a flatter inflection curve. So Manitoba, Saskatchewan, some Atlantic provinces have seen fewer cases over the last month, which means that reopening should be an easier process for them relative to places like Ontario, Quebec, which have seen a significantly higher infection rate.
Yeah, I appreciate you look at this. We have heard from a number of economists that Alberta is one of the provinces likely is going to be the hardest hit in light of their impact and their long reliance on the oil sector and the change of that. And that those sectors that might actually come out well are ones that are related to agribusiness and agri-food, because there is a greater sense of and a need of food security that we're looking for. What is your take on agribusiness, just that particular sector? Robert, if you want to look at that or touch on that.
Sure. Obviously, agribusiness is one of the few that has seen, I don't know, a silver lining or an increase in demand from the crisis that we're in. However, they are dealing with the same difficulties as everyone else in terms of keeping their employees safe. We've seen that across meat packing plants in both Canada and the US, but the demand is still there. We're operating in somewhat of a data vacuum, if you will, because we traditionally receive economic data about 6 to 8 weeks after the end of the month. So right now we're still trying to piece together what's happening in March and April before we can even look ahead to May and June. But the early data we have seen has shown a significant impact in grocery store sales as a result of stockpiling. So that is going to carry benefits for the agribusiness.
Yeah. And I think what you're bringing up a really good point. We are dealing with a situation that we can't really compare to prior crises, other recessions that we've had. They're more difficult to compare. And at the same time, we don't have any data or not sufficient data. What kind of data are you currently using when you're looking at what tomorrow, the next 3 months, a year and 2 years from now will look like? Mazen, if you wanted to maybe touch on that.
Sure, I'd like to touch on it a little bit. Yeah, I think Rob had touched on some of the key ones already. Obviously, the labor data will be particularly important to get an idea of the degree of permanence that the shock may have had. I think one of the major concerns going forward is that there are going to be, suspect some industries and some sectors that may have a more permanent scarring, some kind of permanent loss of capacity. So from that perspective, the employment data will be particularly important because it also may have a psychological impact. I think in economics we call it hysteresis effect, where there is just permanent high level of unemployment in some pockets of some sectors. So the labor data will be key. Consumer spending, retail sales will be another key one as well, because that will give you a sense of the barometer or the degree of a bounce back that we do see. I think given the nature of the shock, I think it's fair to say, and I'm sure Rob can dwell on this a little bit further than I can, but it's looking at a level shock in level of output in the economy. So we're going from here to here, and obviously we have a very significant dip first, but while we may have a fairly robust reacceleration, call it in say 2021, for instance, that on a rate of growth basis, the actual level of output would have shifted significantly lower. So employment data, consumer spending data, obviously housing will be a key part of that aspect as well, to get a sense of how much of that spending will continue, and to get a sense of that marginal propensity to consume, which I suspect will be much different and perhaps a little bit more muted now compared to where we were prior to the crisis. But maybe I'll just hand it off over to Rob to dwell on this a little bit further. He does a lot of the data analysis for us at TD.
Thank you, Mazen. Robert, do you want to touch on this?
Yes, certainly. So Mazen mentioned the labor market data. That's going to be tremendously important over the near term, just because it is more timely, and as Mazen mentioned, there is that confidence effect when people see headlines that the Canadian economy lost 1 million jobs in the month of March. That might make them think twice about spending on a big ticket item while they are locked at home, locked in quarantine. Looking ahead, we will get the April labor market data on Friday. That is going to be a significant one in reassessing the outlook. Our expectation is that could show up to 4 million jobs lost during the month. So 1 million was the previous record. Before that, it was nearly 200K. Now we're suddenly talking about 4 million jobs lost in a month. So it is a very unprecedented shock to the labor market. We're looking at an unemployment rate near 20%, and that's even with some newly unemployed Canadians who have simply given up looking for new work. And if you want to look at other data, typically we would focus on things like retail sales, manufacturing activity. These do come out with a lag, so it's not as easy to make judgments about the performance in those industries. So we're watching a lot of surveys right now. A lot of new ones are being invented, actually. Statistics Canada published one called the Canadian Survey. It was the Canadian Survey on Business Conditions, and that essentially showed that 10% of all firms have laid off their entire workforce by early April. So we're having to look to alternative data sources in the current environment. Some large companies like Google and Apple have also made mobility data available, so we can actually track to what extent people are staying at home versus going on with their daily lives. And those type of indicators will be very important in judging how much of the economy has actually returned to normal life before it does show up in the labor market and the GDP reports.
I appreciate both of your perspectives on it. I have looked at even markets across like worldwide. I think everyone is struggling for data because it's such an unprecedented time. But I'm also really encouraged to seeing how some organizations are actually stepping forward to getting more of a pulse than what we have seen in beforehand. Mazen, this one is probably more geared towards you. Niagara represents one of Canada's busiest border crossings with the US. What impact does the US economic situation have on our economy and on our recovery? And in light of you being located in New York City, maybe a slightly closer pulse to it. Mazen, what's your take on that?
Sure. I think maybe there are two main angles to look at this. I think that maybe one of the first most obvious ones is in terms of tourism. That's a big component for the local Niagara community, and certainly even within New York as well, around that border. And from a local perspective, as part of the labor force, it's also, I think, roughly about 15 to 20% of the workforce there. So it is a significant size in terms of how much knock-on effect it will have into the rest of the local area within Niagara. So that's one angle. The offset to that, I think, is that we have seen a significant appreciation in the Canadian dollar, and cross-border travel between that border is generally one of the most traveled borders across Canada, within the Canadian borders. And so that could help down the line in terms of supporting tourism sector, supporting local demand for other products and services that is offered in Canada that may be more expensive in the US. The other aspect I think that's particularly important, and if you think about it, is from an export point of view and just level of trade. The Ontario borders a lot of the top trading partners for Canada. You think about Michigan, you think about New York, you think about even California, Illinois as well, further down south, further below that. But I think if you're thinking about once we have more return to normal, whatever that normal might look like, you think of some of the sectors that may bounce back earlier are sectors that may have a little bit more inherent social distancing already in them. And so to this extent, manufacturing plants could be one of those areas that you see a rebound potentially sooner because it's generally, I think, a little bit more low contact from a personnel perspective. And I know within the state of New York, for instance, Governor Cuomo has implemented a 4-phase reopening program, which is very similar to that, basically reopening businesses and functions that have very low touch, low social interaction. Manufacturing will be one of the first things that will open up. And so that may help to restart some of the activity across the border. And I think a weaker currency aids in that regard as well. And further down the line, I think actually you will see additional depreciation in the currency for a number of reasons, but there will be another, I think, fundamental adjustment lower in the Canadian dollar. And so I think that could, while maybe a bit of a pain in the short term, I think longer term, it may actually set itself up to be better positioned to rebound.
Yeah, I appreciate that. Robert, I'm not sure, do you want to add anything to it?
Sure. So traditionally, the U.S. economy has been one of the most important factors when looking at the outlook for Canada. As Mazen said, that outlook is going to be helped by a weaker Canadian dollar. And also, we expect the U.S. economy may fare better through this crisis just because it's got less reliance on cyclical industries. It doesn't have the same household debt issues that we are facing. And that should benefit us during the recovery. However, I think over just the next couple of months, the Canadian and the US economies will be operating on their own wavelengths. And that is because if most of us are at home under quarantine orders, there isn't going to be that same link between the two economies to some extent. I think in the near term, the outlook is going to be guided by the relaxation of those stay-at-home measures, which will be also, informed by the progress in fighting the virus in different regions. But I think that the strength of the U.S. economy will be something that helps pull us out of this recovery, and especially for regions like St. Catharines and Niagara, where you are much closer to the border.
Yeah. I appreciate that, and we also appreciate Premier Ford's announcements this week of actually allowing some of the businesses to start actually moving forward again, and starting to change some of the measures that have been in place has been greatly appreciated by businesses. One of the questions that has come in has to do with the real estate market and what impact it will have on the real estate. So early on in March, when we looked at the figures, we couldn't really see the same impact as we could see in some other sectors yet. We have had reasonably strong many years in real estate, especially down here in Niagara. But gentlemen, how do you foresee this impacting the real estate market as we're looking at the months to come and for the next year and 2 years? Robert, do you want to take that one maybe first?
Sure. So I think when you're looking at the real estate market, you have to look at what's happening to consumer sentiment. You have to look at what's happening to disposable incomes, and both of those are going to be determined by the duration and the severity of the current slowdown. So there is a significant uncertainty surrounding that outlook. But if we just look at the early results, it has certainly been not encouraging. So household confidence is at the lowest level we've ever seen. Expectations for house prices have fallen alongside that. And now that we're starting to get some of the individual real estate data for cities across Canada, Toronto home sales fell about 63% year over year in April, and prices were down 10% month over month. So I think the longer that this slowdown persists, the more motivated sellers become. So if we were all able to go back to normal life in 2 weeks' time, then I think that this would be a great environment for first-time home buyers to get into the market. Affordability has been a huge issue across Ontario and in pockets of BC as well. So there is some hope there. But if this does turn into a scenario where we are still operating well below capacity through the summer, then the shock becomes much more significant.
Yeah. I think if there's anything positive about it, it's probably that we are dealing with a very low interest rate, which might be something that is maybe the positive factor when we're looking at the real estate market, but yet household incomes are being impacted. Mazen, anything on the real estate market?
Yeah, I think I echo what Rob said there. It's been one of the prized possessions, so to speak, over the last several years was the Canadian housing market. Obviously, I think some provinces may be in worse states than others, and that in large part has to do with the debt metrics. For instance, in the western provinces like British Columbia. Whereas in Ontario, I think maybe as a source of upside, I think over the longer term, that could help a place like Ontario would be that there's more economic breadth in the province of Ontario than, say, an oil-dependent Alberta or resource or commodity-driven dependent British Columbia. So I think that could be a source of upside down the road, but there's going to have to be, I think, an adjustment on the housing market, and I think in high density areas like Toronto, for instance, where there's a plethora of condo units. You think about areas and other industries like an Airbnb, for instance. Those things are going to take a hit. A lot of people have second investments, for instance, and so I think you're going to see a lot of challenges from that perspective. But in aggregate, I think the housing market in Canada will need to adjust lower to the new reality. But like I said, I do think there are some provinces like Ontario that could be better equipped, given the economic breadth that it does offer.
Yeah. I appreciate that. And I think we also might actually experience a change overall, because most of us are working, all of us on the screen right now are working remotely. And maybe the sense that we have to live where our employment is actually also going to shift. And so then maybe we will see that some people that are currently traveling and commuting from Niagara into the Toronto market or other markets might say, like, you know what, I might not need to do this. I can actually, I don't need to live in Toronto to work in Toronto, because we might look actually at different ways of actually making employment work too, and moving forward. So we might see a shift overall in how we live and work and where that takes place. We have Vivian Kanat with us, and she has a question for the two of you. And here's the question. A process of deglobalization of the supply chain has been raised as a potential response to COVID-19. Do you think this is a feasible response? And if so, what implications does this have to and for Canadian businesses? And Mazen, if you wanted to take it first, and then I'll pass the mic over to Robert.
Sure. So I think that's a great question. And I think that is I'm not sure if I would characterize it necessarily as deglobalization per se. I think it will be selective. And I think the shift that we will see will be more of an onshoring of supply chains. And I think one of the major news stories, I think, in this crisis was that the countries, those that needed medical supplies were not able to get it in time because the supply chains for those products were located abroad. And so I think we may see a shift on that front, not just for medical supplies, but for other areas of business as well. I think that has enormous structural implications, because one of the things that we've dealt with generally since the early 90s has been the issue of inflation control. While inflation is not an issue right now, we're in a deflationary shock at the moment. Longer term, that onshoring of supply chains brings back money into the economy. That also could help prop up businesses in areas, like you think about the secular hollowing out to some extent on the manufacturing side that we've seen in Canada. You may see some of that get restored. And it's going to be a long process before that happens. But I do think that is one of the areas where you will see prop up in terms of a structural economic shift away from being dependent on foreign sources for goods. The other thing, if I can just add as well, is that at least within the United States, I think the issue of, one of the more notable things has been the friction between US and China. Some of it is just for the headlines, and some of it I think is actually legitimate. And it's something that we've seen over the course of the administration, which is basically not necessarily a China-friendly policy. This idea of a more hawkish stance towards China. And I think what you could see is that developed democracies, developed economies band together to proceed in this sort of onshoring of supply chains. That I think will be, again, more of a structural, longer-term issue. But I think that process has already begun. And if you look in some places like Japan, for instance, the government has already provided subsidies to a local medical company to start investigating ways to onshore their supply chain. So I think it's a political issue that also has bipartisan support. So whether you see a Democrat or a Republican in office in in the next election, I still think the issue of this onshoring of supply chains will become very topical. And I think that can actually have some positive implications from an income point of view to help prop up some of the wages domestically for some pockets of the economy. But I don't know if Robert has any other thoughts on that as well.
Robert, over to you.
I would echo what Maz said. I would also point out, though, that I think the winds of globalization began to shift a few years ago before coronavirus even showed up on our radar. Certainly, all the sentiment against NAFTA and Trans-Pacific Partnership showed a growing angst in the US to bring more supply chains onshore and try to revive the manufacturing industry. And as Mazen said, this has sort of become a more bipartisan approach now that coronavirus has reinforced the need to have those domestic supply chains. I think it may be that we look more towards regional supply chains than national supply chains. For Canadian businesses, this might Canadian businesses might see some benefit from US firms that are trying to move away from China and Europe and South America. But it is also going to be a more nationalistic environment going forward as well. So I think it's positive that we got NAFTA out of the way before any of this happened. And now that we have USMCA or CUSMA ratified, hopefully that is something that will help lift us out of this current slowdown.
Yeah, I appreciate that. Actually, it was interesting. Earlier this week on Monday, chambers from across Niagara held a video conference with the Honorable Melanie Joly, who's the Minister of Economic Development for Canada. And a similar question was asked of her as well. And she looked at specific sectors and saying that likely our supply chain will change there. And one of the number one ones was that when it comes to medical equipment, that I think countries are now looking at that aspect of it and saying we need to be more self-reliant in light of what is happening, in light of also the risk that another pandemic will arise, another crisis that we might have to deal with that will impact our health system. So I appreciate that. This is a question that a person had submitted actually last night, and I think it's a really interesting one because during this crisis, private and public sectors have become more intertwined than ever before. The prominence of the public sector and private enterprises is at an all-time high. How will we move forward from here, and what are the effects and risks of this intervention? I think we all saw that the need for the intervention, and we all are supportive in how quickly our governments have actually reacted to the needs that were there. But it's something that we have never seen in beforehand. And so what impact does it have, and how do we move forward from here? Robert?
I think the recent cooperation between the public and the private sector to fight coronavirus is more akin to something we would see during wartime periods than something that will become the norm going forward. Certainly we saw it in World War II in the US, and the US government has been using the Defense Production Act to secure supplies of protective equipment and ventilators. So it's not something that has never happened before. I think in the meantime, it's a very creative solution to help get around some of the obstacles towards ramping up production in key sectors. But I'm not as convinced that this will become the standard going forward.
Okay. And Mazen, from your end, from your point of view?
Yeah. So I think the nature of the involvement of the public and the private sector may be hard to whittle down anytime soon, and that I guess it really depends on what kind of involvement that has taken place. I could certainly see that if longer term, if it remains the case, then that can impact decision making for some of these private corporations. And I think obviously it also matters, I think, what the political climate is. If we do see a shift to a more nationalistic stance, rightly or wrongly, then maybe that discussion, it looks different. And maybe there's maybe more of a tolerant society of that kind of setup. I suspect that won't be the case. And I think we can all agree that you need to have that public and private cooperation in a crisis like this. And I think it's going to really come down to how crisis management evolves from here, right? A lot of that's going to be dependent on how do governments and businesses manage the reopening process. Is there going to be enough testing? Will people feel safe and confident? That psychological impact. Maybe things will change once there is effective treatment and there is more information and studies done on the virus itself. So I think that's a loaded question, and I think it's very difficult to answer that question without having more information on the nature of the shock that we're dealing with currently. But I think it may take some time before we move away from this sort of government or say public and private cooperation, because I think it's going to be needed for some time.
Yeah. And I think out of all of it, in some cases, good things have come out of it too. The way the public sector has leaned on the private sector to help them out and to support them and helping them out. I think we have seen some good things coming out of it, but overall, we are more intertwined than we've ever been beforehand, and I think it will be for a short period of time. I don't and can't foresee that this is going to be in the long term, except we might look at some specific sectors. Talking about this, there was an email that has come in and the question was regarding one particular subsidy, and that has to do with the commercial rent relief. And this is in Canada. It's the rent relief is actually mandated by the province, but in this particular case, the federal government and the provinces and territories across Canada have come together to offer something to tenants and landlords at the same time to relieve that expense and that pressure as businesses are really cash strapped at the time. The question has come forward, what is the role of financial institutions when it comes to assisting in these with these measures when we're looking at buildings that are mortgaged, buildings that are often being dealt with are part of mortgages that are being held with banks and financial institutions. Is there a role for financial institutions and banks when it comes to reliefs for industries and sectors that really do need some help? Mazen, if you wanted to take that one.
Actually, if you don't mind, maybe I'll pass that off first to Robert, because I think he's been following that very closely. I'm happy to follow up with that as well afterwards.
Yeah, and Robert, it's another loaded question, but I think most economic questions and most of the ones that we have this morning are complex. But we would appreciate your take on it.
Sure. So we're still waiting for the full details of the commercial rent assistance program. But from my understanding right now, it is going to be administered by the Canadian Mortgage and Housing Cooperation. So financial institutions will not be directly involved in the program. We have seen financial institutions become more involved through the emergency business account, as Scott mentioned in the introductory remarks to today's webinar. But for the commercial rent assistance, we expect that will be handled by the federal government directly.
Yeah. What is interesting at this point, when we look at that, there are certain people, there is a majority of businesses and small and medium-sized businesses that are impacted by this one. But it relates to another one that actually came in through social media. And that was the question, which sectors will flourish during this time? Which sectors will we see grow when we look back in a year or 2 years from now and saying like, while we have seen a tremendous growth in those areas, this has been positive and for those sectors. Where do you foresee it? Robert, do you want to take that?
Sure. I think it's hard to come up with a long list of sectors that are going to see tremendous growth from this crisis. I think if we want to look at the sectors that are going to be most affected, Services are obviously at the top of that list. And within services, any firms or industries whose business models require employees and customers to be closely interacting with each other will see a more significant impact. So things like airlines, restaurants, accommodations, spectator sports, these are all industries which may not go back to normal for some period of time, or which may see a new normal over the next 1 or 2 years. Industries or sectors that should fare better, we already mentioned the agribusiness. They're obviously well positioned to benefit during the next few quarters, but a little more skeptical that's going to be sustained once life does go back to normal. But I think if you look at things like construction, there's going to be a massive demand for infrastructure once this is all said and done. Already you've seen on a more local level, I think a lot of municipalities and provinces are trying to rush projects where they can, just because there are fewer people on the roads. And it's also a way to support the economy and the recovery in an industry that can operate with social distancing in place, if you will.
Yeah, I appreciate it. Mazen, instead of asking you the same question, we have a few questions that have come in, and I would love to get through as many as possible. I was wondering if I can direct this next one to you. And this gentleman said, even amid fears that the massive influx of government spending will result in inflation, national inflation has already fallen by 2.2% in February to 0.9% in March. And some economists are warning, conversely, of a deflationary period. How will this crisis affect inflation and the money supply?
Sure. So great question. I think, looking at the shock, I think the initial, it's not just a supply chain, supply side shock, it's also a demand shock. All of us are basically at home, and spending has been significantly reduced in the aggregate economy, but perhaps better supported in pockets of the economy like groceries, as we've talked about before. But in terms of inflation and money supply, I think we're kind of living in an era now where we sort of had this experiment in 2008, and the great monetary policy experiment in 2008, where we saw a dearth of new facilities and programs and unorthodox measures to address a compelling problem and shock. What we're seeing now, what we saw in 2008 pales in comparison to what we're seeing now. So there was that playbook that existed before, and we've added significantly more to that playbook. I think in terms of inflation and deflation, I think initially it will be a deflationary shock. The level loss of output will be significant, and that in of itself means is that when you look at a long run economic rate of economic growth for an economy, it operates on this sort of potential, right? It has this potential rate of growth. The initial shock is going to take us significantly below that, and then it creates a lot of slack in the economy. And in order to generate inflationary pressures, the economy needs to run at a rate that is well above that potential growth rate. That's probably going to take a number of quarters, if not years, to overcome and develop inflationary forces within the economy. And so the issue of inflation, I think, is one that's probably not something, at least in my perspective, maybe Rob has a different perspective here, is that it's not something that we're looking to deal with, at least within 5 years, over the next 5 years. We may see a lot of volatility in the inflation metrics over that time, at least initially, for sure. But I don't think really, inflation is probably something that we can deal with more effectively than deflation. And the challenges from that come through monetary policy itself, in that we've seen central banks drop their policy rates to zero, and in some jurisdictions they've implemented negative rates, and there's not a whole lot of positive feedback in terms of using these unorthodox measures like a negative policy rate, because it does impose some damage in terms of financial intermediation, banking system, and that could also impair credit creation down the line. So that's one. The other aspect I would say to that is that yes, liquidity has been injected into the economy, money supply will expand, but you're seeing again a government and monetary coordination, if you will, between the two. And I think maybe one of the challenges down the line that I would be thinking of is that we've already had rampant spending in some pockets of the global economy. You definitely have seen it in the U.S. for a variety of reasons, and now we're seeing unprecedented amounts of fiscal spending. I think it's safe to say that we will probably not see higher interest rates for a long. I would say at least a couple of years. Maybe Rob has a different take on that. Maybe even longer. And so that will be one of the consequences of running these large fiscal deficits, for instance, is that you're basically giving a green light for these fiscal agents to basically spend at a low cost of finance. And so I think the issue, the question of concern on the money supply with the expansion of central bank balance sheets just to help support the economy and financial plumbing of the economies. But I don't think that will be an issue that we deal with as long as interest rates remain low. And I think central banks have demonstrated in the past crisis that there is a way to sort of deal with that once the time is right. But the implication here is that basically interest rates will stay low for quite some time. That could create other issues down the line, but I think it will be something that will be necessary for quite some time.
Yeah, I agree with you, and I think we foresee the same. Robert, what's your take on this question?
I would certainly agree with Maz that deflation is the much bigger risk than inflation in the near term. We're already at 0.9% year-over-year inflation for March, and it's likely we will be at 0 by May at the latest. So it is a significant risk, and it's the reason why policymakers, both the federal government and the Bank of Canada, have gone to such unprecedented lengths to support the Canadian economy. If we talk about where economic output is, the level of economic output versus its potential, our best estimate right now is we're operating at about 80% capacity for the months of April and May. So that is a significant amount of slack that opens up, and it's going to require a period of above trend growth to get back to normal. So the Bank of Canada has helped facilitate the recovery and the adjustment by cutting rates to the lowest level on record, 0.25%. And they've also purchased about $250 billion in assets through quantitative easing and other programs to help support the financial intermediation and just market functioning. So when funding pressures began to emerge in late February and early March, the Bank of Canada introduced programs to purchase commercial paper and bankers' acceptances on the open market and through new issues, and that actually helped contain those funding pressures, which have since normalized. The federal government's also been spending quite aggressively to help contain this crisis. So right now they've introduced direct spending of about $150 billion. Of that, roughly half is emergency wage subsidies, but you also have the emergency response benefits, forgivable small business loans, and a number of smaller initiatives. They've also introduced about $320 billion in liquidity measures. So these are things like deferred tax payments and the non-forgivable portion of these loans, and EDC and BDC lending as well. So there has been a very significant response to date. However, if this situation continues to deteriorate, it's likely that more support will be needed.
And that links actually directly into one of the questions from one of our attendees. And the question specifically is saying, what do you believe the effects of a second wave in the fall and the subsequent second shutdown will be while we're still recovering from the first one? And Robert, just because you were just answering the previous question, do you want to give us your take on that part?
Sure. Well, I think in terms of the level of economic activity, we may not see much more of a decline. It's just we'll be operating at a reduced rate for longer. And that carries risks for what happens to a household's balance sheet, what happens, how long can businesses afford to keep paying fixed and variable costs. And it introduces a lot of longer term risks to the outlook. Right now, the Canadian government's paid about $30 billion in these emergency response benefits, but that's only about 8 to 10% of traditional disposable income. So when 20% of the workforce is looking for a job, that's not going to fully offset the lost income. So certainly, if there is a second wave and we have to roll these emergency measures back into place or keep them in place, then you are going to look for more support from the federal government and central banks, but you're also going to see a more significant long-term impact or scarring from this crisis.
Yeah. I can see that this actually needs to be a much longer conversation than this 1 hour that we have, but I'm conscious of the time. We are like about 4 or 5 minutes before 11 o'clock. And I was wondering if in your closing comments, you can also somehow include this perspective. And this has come forward from someone who was social media, and it's asking, looking forward beyond the next weeks, months, or potentially years, what will be the lasting marks that this pandemic has on our economy? So if I could ask each one of you in your closing comments to somehow maybe take a look at that too and saying, what does it look like years from now, looking back on this one? What will be the lasting mark it has left on our economy? And Mazen, if I can ask you to maybe take this first.
Sure. It's a good question, and also a very, very much a loaded question as well. I think, look, I think it will probably lead to, as much as there are some drags associated with the current shock that we're dealing with now, it also creates opportunities. And I think in some of the earlier questions that you had asked before about what sectors have been most positive, could be negatively and most positively impacted, I think you'll definitely see a shift in terms of attitudes, in the sense that you may have more work from home friendly type of operations that could also have other implications in terms of just work-life balance, perhaps, and that could also have knock-on effects in terms of the commercial real estate market, where there may be less demand to actually have all this office space if you can just operate as efficiently or even more efficiently from home, which is, I think, generally what we've been hearing and seeing recently. So I think it will create a lot of structural long-term changes and pivots. Obviously, crisis management will be another one. In some cases, it has failed. In other cases, it has been remarkable. So I think maybe if there's a lesson learned from here, is that you can have everyone band together and reach a common goal and common purpose. And I think that's encouraging in of itself. But in terms of other long-lasting impacts, I think, the structural changes that I think we'll likely see from this once in a 100-year type event, and some of it deals with perhaps the permanent scarring we see in some job markets, but also a building of new skill sets for other things that may be perhaps more technologically and innovative and forward-thinking as well. So I think there are some drags and some upside as well, but yeah, we'll see how things shake out.
Okay, thank you very much. We are in uncertain times. I think it's hard sometimes to predict what and how it's changing. One of the things that some people have mentioned is that the way we look at healthcare is going to significantly change. So this is a sector that most definitely we will look at differently and look at the priorities within that sector too. Robert, your take on this and your closing comments.
Yeah, I would just wrap up by saying this is truly an unprecedented shock. There's a lot of uncertainty about how things develop from here. But so far, we've also seen an unprecedented response from governments and central banks to help counteract some of these negative forces on the economy. While we had already been seeing a decline in globalization that was sort of accelerated by coronavirus, this has also brought a new spirit of global cooperation as we try to develop vaccines and learn from other countries that may be ahead of us on the infection curve. So there is certainly some hope that this will renew global cooperation, which has been under strain over the last couple of years. And as we look forward, it's very likely that norm will look different in the future than it had in the past. Mazen spoke of some of the structural changes. I think the sort of cloud computing and working from home is something that is going to become semi-permanent for some employees. I think everyone's been pleasantly surprised at how effective it is for a lot of employees. And it may lead to some hybrid work arrangements in the future. That would certainly weigh on commercial real estate. But yes, it's a very uncertain time, and there's certainly light on the horizon. We've seen some decline in the flattening of the curve and lower in new infections. So we're hopeful as we look forward.
Yeah, and I think we have to be. Robert, Mazen, thank you so very much for being with us this morning. When I look at the dialogue just over this last hour, I can see that there's such a need to have it on an ongoing basis and to check in every month or every 2 months, and even in like 3 months, 6 months down the road, to really get a pulse of what our economy looks like. But we will make it through it, and we will look back on this time. And I think the learning that we're all looking for right now is taking place at rapid speed. So thank you for your input and your eyes on the economic picture that we're facing currently. Today's webinar has been recorded and will be available on our website at GNCC.ca and will be emailed to all webinar participants directly. We spoke throughout the webinar about a few resources and subsidies. For a complete list, please check out our website. If you would like to reach out to any of us directly because you have any questions regarding any of the subsidies or resources available to you, we can always be reached at info@gncc.ca or directly at mishka@gncc.ca. Lastly, to all attendees, thank you very much for joining us this morning. Please stay in touch, and above all, stay healthy. Thank you.